Thinking about investing in startups, it can be exciting, risky, and potentially very rewarding. But it's not like buying stock in a big public company. In this video, I'll break down the key things you need to know before jumping in, how startup investing works, the risks involved, and how to spot real potential. Whether you're curious or ready to make your first move, this will give you the foundation you need. Today we will talk about investing in startups, what you should know. So before we start, make sure to hit the like button and subscribe to my channel. 1. Startup investing. Investing in startups refers to providing capital to early-stage companies in exchange for equity or a share in future profits. This form of investing has gained significant popularity in recent years as startups have driven innovation in sectors like technology, healthcare, fintech, and clean energy. Unlike traditional investments in public stocks or mutual funds, startup investments are riskier, but potentially far more rewarding. Most startups are privately held, meaning their shares are not available on public stock exchanges. Investors typically enter through venture capital firms, angel investing platforms, or direct personal connections with founders. The goal is to invest early in a company with high growth potential and exit later through an acquisition or initial public offering (IPO). However, startup investing demands due diligence, patience, and an understanding that many startups fail before becoming profitable. For investors seeking high-growth opportunities and willing to tolerate volatility, startup investing offers a dynamic and impactful option to diversify their portfolio and support entrepreneurship. 2. High-risk, high-reward. Startup investing is characterized by its high-risk, high-reward nature. Statistics indicate that around 90% of startups fail, often due to poor product-market fit, lack of funding, weak leadership, or competition. However, those that succeed can generate substantial returns, sometimes yielding 10x or even 100x the original investment. For instance, early investors in companies like Uber, Airbnb, or Facebook reaped exponential gains when these startups went public or were acquired. The key is to recognize that failure is common and that the odds are not in the investor's favor unless they diversify across multiple startups. Unlike blue-chip stocks or bonds, startup investments are illiquid, meaning your money is tied up for years with no easy exit. This illiquidity and uncertainty require a different mindset and a longer investment horizon. Sophisticated investors use these investments not as a core portfolio component, but as a speculative or satellite asset class with the potential to generate outsized returns that can counterbalance lower-yielding traditional investments. 3. How to invest in startups. There are several ways to invest in startups, depending on your financial capacity, risk appetite, and regulatory requirements. Accredited investors, those who meet certain income or net worth thresholds, can invest directly through venture capital funds, angel investor groups, or private placements. For non-accredited investors, crowdfunding platforms like Seed Invest, Republic, Start Engine, and WeFunder provide access to early-stage deals with lower minimum investments, often starting at $100. Angel investing typically involves individuals providing early funding in exchange for convertible notes or equity, often participating in mentorship or strategic guidance. Venture capital firms pool capital from institutions and high net worth individuals to invest in scalable startups, usually at a later stage. Some investors join startup accelerators or incubators that offer curated opportunities. Conducting due diligence, evaluating business models, founder experience, and market potential is critical. 4. Key evaluation criteria. When evaluating a startup for investment, it's essential to assess several key factors. First and foremost is the founding team. Their experience, industry knowledge, and execution ability often determine a startup's success. Investors look for resilient, visionary founders who can pivot during adversity. The market size is another crucial metric. A startup should target a large, growing market to justify long-term scalability. A unique value proposition or competitive advantage, such as proprietary technology, a novel business model, or intellectual property, enhances investment appeal. Traction matters too. Evidence of user adoption, revenue growth, or partnerships indicates real market validation. The financial model should outline realistic revenue projections, cost structures, and runway. Understanding the startup's exit strategy, whether through acquisition, IPO, or merger, helps investors envision how and when they might see returns. Lastly, the valuation must be justified. Overvalued startups may dilute investor equity or hinder future fundraising rounds. 5. Legal and financial considerations. Startup investing involves complex legal and financial structures that investors must understand. Most early-stage investments are made through equity, convertible notes or SAFEs, simple agreements for future equity. A convertible note is a short-term loan that converts into equity at a later funding round, typically with a discount or valuation cap. A SAFE offers similar terms without being a debt instrument. Investors should carefully review term sheets, which outline rights such as liquidation preferences, anti-dilution clauses, and voting rights. Taxes also play a significant role. The U.S. offers a tax benefit under Section 1202 of the IRS Code for qualified small business stock, QSBS, allowing investors to exclude gains from federal taxes if certain conditions are met. Investors must also account for capital gains taxes on any exit profits. 6. The role of diversification. Diversification is a fundamental principle in managing startup investment risk. Since most startups fail, allocating capital across a broad portfolio of startups increases the probability of hitting a unicorn, a startup that grows exponentially or exits successfully. Angel investors and venture capitalists typically follow a portfolio approach, investing in 10 to 20 startups or more to increase the chances that one or two generate outsized returns that compensate for others that fail. It's also advisable to diversify by sector, geography, and stage of development. For example, combining early-stage tech startups with later-stage healthcare or consumer startups can reduce overall volatility. Diversification helps investors mitigate the impact of unforeseen industry changes or regulatory shifts. 7. Startup trends and emerging sectors. Understanding current market trends can help investors identify promising startup opportunities. As of recent years, sectors like artificial intelligence, climate tech, blockchain, health tech, and remote work solutions have attracted significant venture capital attention. Startups focused on sustainability, circular economy, and carbon neutrality are particularly appealing as environmental concerns rise globally. Similarly, fintech and edtech are evolving rapidly, driven by digital transformation and global financial inclusion efforts. The post-COVID world has also spurred growth in telehealth, e-commerce, and cybersecurity. Moreover, government incentives and public-private partnerships are boosting innovation in sectors like clean energy and biotech. Investors should track industry news, accelerator reports, and funding databases like Crunchbase or PitchBook to stay updated on high-growth areas. Keeping an eye on demographic shifts, consumer behavior, and emerging technologies allows investors to anticipate what's next. Strategic alignment with growing sectors not only increases return potential, but also aligns investments with long-term global trends and needs. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.